Hello, everyone. Greetings from the channel, Autodidact. We are back in continuation of Module 1 for Part 2 of Stock Market Investment, a complete course to make from a naive to an expert, where we started the very first module including essentials of stock investing. We extended our learning towards the basic terms and concepts that are commonly used in the stock market. In the previous session we understood a share or a stock. It is a type of security that indicates ownership in a corporation and represents a claim on a part of that corporation's assets and earnings. The two primary types of stocks are common and preferred. Equity share, also known as ordinary share or common share, entitles the owner to vote at shareholders' meetings and receive any dividends that the company issues. This is the type of stock we will be talking about throughout this module. Preferred stock doesn't usually confer voting rights, but it does include some rights that exceed those of common stock. For example, preferred stockholders have priority in certain conditions, such as receiving dividends before common stockholders in the event that the corporation goes bankrupt. Additionally, preferred stock seeks to operate similarly to a bond for investors seeking stable income. Moving ahead with stock symbol, a stock symbol is a 1 to 4 character alphabetic root symbol that represents a publicly traded company on a stock exchange. This code is used while you are either selling or buying a stock on the stock exchange. This is provided by the stock exchange to avoid any conflict and ease of selection. It can be understood very much like roll number in your school or college. For instance, Reliance stock symbol is RIL, while Infosys is recognized as INFY or INFI. Similarly, Apple's stock symbol is AAPL. Please note that BSE issues a unique 6-digit number as the symbol. When it comes to buying and selling of shares, there are 3 kinds of companies: the small cap, mid cap and large cap. The classification is dependent on the market capitalization of these companies. The corporations which have a market capitalization of up to Rs 5,000 crores are considered small cap companies. The ticket size of companies is usually very low. These stocks are the smallest, and hence the riskiest, yet still have plenty of growth potential. The key word here is potential. Next is mid-cap. For many investors, this category offers a good compromise between small caps and large caps. The market capitalization is more than Rs 5,000 crores and lesser than Rs 20,000 crores. These stocks have some of the safety of large caps while retaining some of the growth potential of small caps. And the last category is large cap. The companies which have market capitalization of more than Rs 20,000 crores. This category is usually best reserved for conservative stock investors who want steady appreciation with greater safety. The companies have been performing consistently over the years and proven themselves with their results. Stocks in this category are frequently referred to as blue chips. Remember, these capitalization levels are valid for the India. Different countries have different caps and their categorization. Few countries categorize them as micro, small, mid-cap, large and ultra-large cap. From a safety point of view, a company's size and market value do matter. All things being equal, large-cap stocks are considered safer than small-cap stocks. However, small-cap stocks have greater potential for growth. Although market capitalization is important to consider, don't invest or not invest based solely on it. It's just one measure of value. As a serious investor, you need to look at numerous factors that can help you determine whether any given stock is a good investment. The stocks behind large, industry-leading companies. Blue-chip stocks offer a stable record of significant dividend payments and have a reputation of sound fiscal management. The expression is thought to have been derived from blue gambling chips, which is the highest denomination of chips used in casinos. The term blue chip was first used to describe high-priced stocks in 1923 when Oliver Gingfield, an employee of Dow Jones, observed certain stocks trading at $200 or more per share. Poker players bet in blue, white, and red chips, with the blue chips having more value than both red and white chips. Today, blue chip stocks don't necessarily refer to stocks with a high price tag, but more accurately to stocks of high-quality companies that have withstood the test of time. Think companies like Coca-Cola, Disney, PepsiCo, Walmart, General Electric, IBM, and McDonald's, which are dominant leaders in their respective industries. Blue-chip companies have built a reputable brand over the years, and the fact that they have survived multiple downturns in the economy makes them stable companies to have in a portfolio. All right. Next term is penny stocks. Penny stocks are a form of market-traded security which attracts minimal pricing. These securities are mostly offered by companies with lower market capitalization rates. Therefore, these are also called nano-cap stocks, micro-cap stocks, and small-cap stocks, depending on the company's market capitalization. In India, typically penny stocks generally trade at Rs 0.05 to Rs 10 per share. A few popular penny stocks are Indian Overseas Bank, UCO Bank, Bank of Maharashtra, Future Consumer, Centrum Capital, CG Power, HFCL, HMT and PTC India Financial have all turned penny stocks. Moving ahead towards the trading, the ask price and the bid price. The ask price is the price of the share at which the shareholder is willing to sell his holding. It's a combination of rupees and paise. Like, you want to sell Mahindra at 300 rupees and 20 paise. Then, it is your ask price. Conversely, the bid is the amount of money a trader that he is willing to pay per share for a given stock. Like, for the same share is ready to pay rupees 299 and 90 paise. He will place his bid at this price. Then, it is balanced against the ask price, which is what a seller wants per share of that same stock. The trade will execute only if the bid price and ask price are absolutely equal. Difference of even a penny will keep the trade open. Note, every moment, thousands and lakhs of bids are placed, but all of them are not executed. One thing that you've noticed in this case of trading Mahindra, the ask price is rupees 320 paise, while the bid price is rupees 299 and 90 paise. The difference is of 30 paise, not even a rupee. This is called spread, so the spread is the difference between those two prices, the ask price and the bid price. Similarly, if a trader is willing to trade Zee Entertainment share for rupees 300 and a buyer is willing to pay rupees 298 for it, the spread is rupees 2. Oh, do not go by the image, though, it is very much like a haircut. But, the stock market does not offer salon services. Haircut is cutting the spread. Means either a situation in which a stock price gets reduced by a specific percentage for margin trades or other purposes. In its most simplest stock market terms, a haircut is an extremely thin spread between the bid and ask prices of a given stock. Beta is a measurement of the relationship between the price of a stock and the movement of the whole market. In simple words, beta is a measure of a stock's volatility in relation to the overall market. It is the degree to which different portfolios are affected by these systematic risks as compared to the effect on the market as a whole, is different and is measured by beta. To put it differently, the systematic risks of various securities differ due to their relationships with the market. The beta factor describes the movement in a stock's or a portfolio's returns in relation to that of the market returns. For all practical purposes, the market returns are measured by the returns on the index, Nifty, Midcap, etc., since the index is a good reflector of the market. For example, if Asian Paints share has a beta of 1.5, that means that for every 1 point move in the market, stock Asian Paints moves 1.5 points, and vice versa. An open high-low close chart, also OHLC, is a type of chart typically used to illustrate movements in the price of a financial instrument over time. With the use of this, we draw a candle in the candlestick chart. In the later part of the course, we will learn to draw these charts with the help of spreadsheet or Excel. Here open when a trader can place his bid for buying or selling. In India, it is 9:15 in the morning. The lowest traded price between the market open and close. Likely, the high is the highest traded price between the market open and close. And the market closes at 3:30 in the evening, after which traders cannot place their normal orders. Volatility is the price movements of a stock or the stock market as a whole. Means that there will be a big gap between high and low of the share price within a day. This gives you an opportunity to make more money. Highly volatile stocks are those with extreme daily up and down movements and wide intraday trading ranges. This is often common with stocks that are thinly traded or have low trading volumes. I'm a big fan of high volatility stocks because I can make a big profit off spikes or dips, depending on how I'm trading, in a short period of time. High volatility often makes trading more exciting, but it's also risky if you're inexperienced. From the volatility, the next important arises is short selling. When you short sell a stock, you borrow shares from someone else with the promise to return them at a point down the road. You then sell the stock for a profit. It's a way to take advantage of a stock that you believe will decrease in price. After you sell short, you can buy back the shares at the lower price point and take the difference in price as your profit. I use short selling on a regular basis. It's often a smart move in a volatile market if you see patterns that indicate a sharp downward turn for a stock. A margin account lets a person borrow money, take out a loan, essentially from a broker to purchase an investment. The difference between the amount of the loan and the price of the securities is called the margin. Trading on margin can be dangerous because, if you're wrong about the direction in which the stock will go, you can lose significant cash. You must often maintain a minimum balance in a margin account.